Many have called 2021 the year of the individual investor due to an explosion in the number of retail stock traders, the influence that they've had over markets, and a huge rise in environmental, social, and governance investing. So, reflecting on this shift, we have commissioned an in-depth piece of research to better understand the behaviours and motivations of retail investors.
Hello, I'm Richard Davis, Managing Director of RDIR, the Investor Relations Consultancy part of the EQ Group. I'm joined here today by Tom Rayner, CEO of Cillian. Hi Tom, thank you for being with us today.
Hi Richard, great to be here.
So many companies are being accused of not being as transparent as they could be in terms of their ESG reporting. How do you respond to that criticism?
I think it's perhaps worth looking at what it is that that investors want to know from the issues that they're looking at. I think there's probably three pieces. The first is the company being operated responsibly as a proxy for it being a resilient business, so happy middle management, etc., etc. The second is some assurance that it's being operated not immorally, because people want to do broadly good things with their money if they can, and certainly not illegal or nefarious things. And I think thirdly, and most importantly, what investors are really asking in ESG terms is, how well is this company positioned for the world of 5 years' time? As we shift towards a more sustainable macroeconomic model, is this a company that's going to be one of the winners rather than the losers? Because there are going to be winners and losers from this broader transition. And I think that companies need to be able to make a case to show how they are assessing what's coming down the line for them, avoiding risk and capturing opportunity. And that's what the best ESG communication does. So I guess we help around the messaging itself and what that should be. When it comes to then delivering that message and getting it out to the stakeholders you want to hear it, institutional or retail, what's your sort of approach to that?
Companies can be doing wonderful things and they can be reporting on those wonderful things in wonderful ways, but then maybe they're not distributing that messaging out to the investment community or wider stakeholders on a thorough enough basis. And I think this is very much a nascent part of the ESG story, actually. So to some extent, I think first of all, we have to make sure that the companies understand who their shareholders are and how much influence ESG has over those investors, not just in terms of the investment firms, but also at the level of the individual ESG dedicated funds. So understanding the share register in terms of the ESG influence is absolutely foundational to this process. Second, I think in terms of getting that message out to investors, and this is not just investors, but also to the wider stakeholder community, but also the target investors, who sometimes the companies sort of forget about in terms of ESG distribution. I think it's actually really important that companies have a very holistic approach to this, in the sense of seeing this as important as the distribution of financial metrics, and indeed bringing in the ESG investors into the communication process at the same level as the equity investors or the debt investors.
So how do you then track those ESG investors on the register?
Yeah, so I think in terms of shareholder analysis, providing that information, that's pretty much in terms of we can analyse to the nth degree who holds the stock in a company, and then understand the attributes of that fund, just as we do in terms of an equity investor. And then we can understand the strategy of the ESG fund itself, and also the portfolio of holdings that ESG fund will have in the marketplace. I think, very valuable route to market, if you like, for issuers is to hold ESG investor days, which are the ESG equivalent of capital market day, where they can talk to investors en masse. And again, this is much easier now in the digital age, and introduce to the market all the processes that go on in the company around ESG, and actually try and also link this back to the strategy of the business overall, and indeed going forward the remuneration of the directors of that company in terms of their performance around ESG issues.
For the sake of debate, if you took a cynical view of ESG and put the CFO's hat on and said that the outcomes of a really good ESG strategy are usually more money spent on behalf of the company in return for positive externalities, so those that accrue to stakeholders outside of the business. And that's the idea of ESG, is that we have better outcomes in the round, but they do cost more money for the company. Otherwise, they would have been doing them in the first place as a matter of course. So how do you then transfer that ESG activity to strategic value? And that's through the communication. So we segment up the audiences that you need to be thinking about, and those are usually investors, internal audiences, customers, and then the general public. And there's great prizes to be gleaned from communicating well: lower cost of capital, reduced churn for staff, reduced salary costs, and a more engaged workforce, and better reputation generally. But yes, it's the communication that translates this cost into an item of strategic value.
So over recent years, there's been a massive upswing in the terms of cash flows into ESG, both in terms of the dedicated funds and into the investment firms that are applying ESG strategies as part of their investment approach. And indeed, there's been a proliferation of ESG funds globally as well. So what should companies be doing to improve the communication of ESG metrics to the financial community?
Yeah, there's a lot of money to be captured there, and a lot of investment to get onto your register, and it tends to be quite sticky investment as well, with quite long-term views around value. So it's an attractive pot of capital to go after as an issuer. I think, firstly, as we said before, getting your story straight about how you're positioning yourself to be one of the winners of this economic transition, because there's going to be winners and losers. And then secondly, getting to know your register and how the upcoming regulation is going to affect what portfolios your company can and can't sit in. So without delving into the jungle of acronyms, SFDR and the EU taxonomy are two of the big ones upcoming in terms of European legislation, and they're likely to be onshored to the UK somehow, though we don't quite know how yet. So yeah, it's a mixture of storytelling as ever with investor relations, and then understanding the limitations of the capital that you're looking for.
I think it's interesting you talk about the use of acronyms, because I think the ESG area is full of abbreviations, which could be very confusing to the retail investor in particular. How can companies get round the use of that kind of language and make their messaging more direct and more straightforward for retail investors?
So I think in the very long term, you'll see even retail investors start to become more comfortable with some of these disclosures, and you're seeing alignment around certain frameworks such as TCFD. It's been really hard in the past, because when there are 20 frameworks to choose from, and each company has a different one that it's reporting against, it takes a long time for an investor, institutional or retail, to upskill to understand what's being reported here. So I think as those popular frameworks coalesce around winners, then you'll see more understanding from investors. But the other side of it is to make sure your messaging is really simple and focus on the bits that matter. If you looked at financial reporting, companies really focus on a couple of key parts of their reporting, be it the results presentation or the chairman's statement. And those are the things that investors are going to go and look at, and those items are emerging in ESG reporting as well, being the TCFD sections, the scenario analysis, and things like materiality assessments.
There's been a lot of talk about Generation Z being much more interested in ESG issues as part of their investment strategy, and also the growth of interest in retail investment amongst the younger shareholders. How do you think companies should tackle the younger shareholders in terms of their ESG approach?
Yeah, it's an interesting one. I think you hear stories from both sides of the age spectrum. I think there's a category of perhaps retired with a bit more money to invest investors who are interested in ESG matters, because I think they see that the next generation might have a slightly more challenging job in accumulating wealth, and they would like to make that job easier rather than harder. But certainly anything from sort of the middle of the millennial cohort down into Gen Z, this stuff's just taken as assumed that you're going to be all over your ESG activities if you're an issuer. In terms of how you communicate to them, I'm not sure it's much different, but certainly investment managers are struggling. One of the big changes we've seen is as wealth gets passed down a generation during inheritance, younger people looking to have that wealth managed haven't been finding the products and services that they want from traditional big name wealth managers, certainly 2-3 years ago, and that was one of the things that spurred them into action to really start understanding this ESG investing landscape.
So if there's one key thing that you'd recommend that companies should do in terms of improving their ESG reporting, what would that be?
I think it's make sure you get your foundations right, which is typically the materiality assessment. So the main point is here that different companies are going to have different things that they can have an effect on and are important on external stakeholders. If you're an IT company, you're not going to have a huge water use problem. So work out what it is that A, you can affect, and B, is a problem for external stakeholders, and work out how you can fix it. Focus on 3 or 4 key things that are having a big impact externally, and you've got the tools to affect internally. And start from there rather than trying to scattershot at all things, be they relevant or not.
Thank you so much, Tom, for some very interesting comments.
Absolute pleasure. Thanks for having me in.